If also you are fed up of second guessing yourself and asking yourself how you can make money in 2026, this is the exact guide that taught my free Discord students and my private mentorship students how to start day trading. I'm providing you this guide here on YouTube because I used to feel the exact way you're feeling right now. You're lost and you want to learn a way to make money in 2026. Day trading won't be able to provide you financial freedom within next week, but I'm sure that within 8 to 10 months you'll learn how to actually execute in the markets. So if you want to learn my strategy for free, please leave a gentle thumbs up down below and stick to the video until the end. See ya. Alright, so first of all, what is trading? Trading is basically how the market moves. There are different markets. There are forex markets, which include the currencies. So for example, US dollar against the GBP or the Chinese yen, euro against the dollar. But that's not what we're gonna trade. So we won't focus on forex. You can trade crypto, for example, Bitcoin, Ethereum, these sort of things. And you can trade indices. Indices are strictly American. So you have, for example, the S&P 500, which is basically the market of the 500 biggest firms in America. Then we can find the Nasdaq, which relates to the market of the 100 biggest tech firms in America. And then obviously the Dow Jones, which is the primary US index. So this was basically what we're gonna focus on. It's very important you guys train first your mindset and psychology, and then you actually start studying the markets. So for example, risk management. Risk management is one of the key things in trading, since you can overcome two emotions while starting out on trading. These are the most important and the worst emotions you can actually overcome while starting out trading. Greed is when you want to make more money than what you're supposed to make. So for example, you move your take profit higher because you want to make some more money, some more profits. And that's extremely harmful for your trading path, since market in these instances can be completely unpredictable, since you will have, before taking an operation, a fixed take profit that you actually are not supposed to move. On the other side, fear is another very bad emotion, since will make you move your stop loss lower, since you don't want to lose that trade. What happens in the end that you're gonna hit your stop loss even lower and you're gonna lose even more money. So please keep your take profits and stop losses fixed. So let's get straight into it. How the market moves. The market moves in three different ways: upwards, downwards, and horizontally. While the market moves upwards, it's called a bullish trend, while if the market moves downwards, it's called bearish. And you're probably guessing, yeah, but what do you mean it moves horizontally? Yes, market also moves horizontally, and it's actually when there is a big move to the upside or a big move to the downside, and that's called consolidation phase. And you can see right here, look at this. Here we have a consolidation phase, since in the long run it's moving horizontally, but if we move, for example, the 5-minute time frame, it's actually moving, as you can see, up and down. So as you can see here, it's consolidating, and then after a consolidation phase, we always have or a move up or a move down. In this case, we had both. But before talking about trends, I actually want to focus on what is a candle. So why do we have candles? Candles are these things that actually show market movements. We have, as you can see up here, time frames which show how much market movement is within one candle. So if we move to the 4-hour time frame, we have a candle that lasts 4 hours of price movement. If we move to the 1 hour, it lasts 1 hour of market movements. 30 minutes, same thing, down to 1 minute of price action. So you're probably asking, why are there these small wicks? These small wicks actually show where price wanted to go before the candle closure. So a candle closes, for example, if you go in the 5-minute time frame, closes in 5 minutes. So it opens at a certain time and it closes after 5 minutes since the opening. During these 5 minutes, the market can move upwards or downwards. If the market moves upwards and reaches, for example, this point right here, it means that the market reached this price, but it has not closed at that price level. but it has closed, for example, here. Now this is bearish, so here. I will draw it for you guys. Here, price has actually reached this point during the 5 minutes, but it has closed below this point, and that's where the body closes. This is a black candle, which means bearish. You probably will have a red candle instead of a black one. This is just how I wanted to personalize my chart, but you will probably have it green and red. Green for the bullish and red for the bearish. Here we have price action that reached this point and this point, but it has closed only here and it has opened here. You have to understand that bullish means that price opens below and closes above, while bearish opens above and closes below. So if I draw a candle right here, guys, this is a bullish candle, obviously. It's green and it's a bullish candle. If we go here and change the color to red, here we have a bearish candle. Again, price, as I've said, has reached this point and this point, but it has closed only here. This is a point where price has closed. Why? Because once the 5 minutes has passed, the candle closes and a new candle will be created. And that's exactly when we will look for entries. So this is exactly what you have to know about candles. Now I want to introduce you guys to highs and lows. So we have, for example, here, blue candles and black candles. Fair enough. So a high is basically a blue candle followed by a red candle, or for you guys, a green candle followed by a red candle. This, for example, is a high. This one right here. Also, in a high and a low, we always take the higher part of the wick. In a high, we take the longer wick, while in the low, we take the longer wick to the downside. Here, for example, we have a high, and here we have a low. As you can see, we have a bearish candle followed by a blue candle, and here we have a blue candle followed by a bearish candle. Now, you don't have to get confused, since here we have also another high. That's another high, there's no problem with that. We have a high and then a low down there. But you have to understand that a high is a green candle followed by a red candle, and a low is a red candle followed by a green candle. Fair enough. Now we can focus on trends. So, as we already said, the market moves bearish, bullish, and it consolidates. What does this mean? When we have a bullish trend, we have a higher high and a lower high, a higher high and a lower high. This means that the market moves in an upward trend. As you guys can see, here we have this high and this lower high. It's a low, but it's a lower high since we're in an uptrend. Same thing here. We have a high and here we have a lower high, as you guys can see. And this is moving in an uptrend. Now it's consolidating and then we have an inversion. But what you guys have to focus on is understanding how the market moves. The market moves, creating higher highs and lower highs, higher highs and lower highs in uptrends. In downtrends, we create lower lows and higher lows, lower lows and higher lows, like this. I will show you an example. Here we have a downtrend, for example. Why? Because we create a low and then a lower low right here. A low and a lower low. And these are called higher lows and lower lows. Fair enough. So what we're trying to find while trading, we're trying to find entries that can predict a market's trend. So it's not optimal to enter a trade while the market is consolidating. Why? Because it's moving horizontally. And that's exactly what we want to avoid. Our objective is, again, to predict a market's trend. A big movement in the market we have to predict. And that's exactly where we're gonna gain profits. Now we're gonna discuss liquidity. Liquidity is the most important concept in trading. It's basically how the market moves, since liquidity lays above highs and below lows. And that's exactly what makes the market move, since it's exactly what the market is seeking for. The market wants to sweep liquidity every time, since again it represents resting orders above highs and below lows. As we can see here, we have liquidity. Here, since we have a high, we also have liquidity that has to be swept every time. I can show you examples over examples. For example, here we have a low. Look at this low. This is a perfect example of liquidity, because we have a low right here that it has been swept. A lower low has been created right here that has been swept, and there was a change in trend. Why? Because the market was seeking liquidity. We can't leave resting orders all over the place. The market always has to gather these orders and make money off of them. So, as you can see here, the market went down and gained all the liquidity that was resting below this low, and it pumped completely bullish. This is a perfect example of a liquidity sweep. I will show you a liquidity sweep to the upside. Here the market had a high, also again where liquidity was resting. We swept this high with this move to the upside, and market dumped to the downside. So guys, please focus on learning very well how liquidity moves and how resting orders are created, because this will be very helpful. So write this down and repeat what liquidity is and how you can spot it. Another great tool we can use to enter trades are fair value gaps. Fair value gaps is one of the most important confluences we use in my strategy to enter trades. They are basically imbalances within price action. So here we have a perfect example. It's basically when we have a gap between the last wick of the first candle and the first wick of the last candle. And as you can see, here we have the last wick of the first candle and the first wick of the third candle. There's a gap. This gap is called a fair value gap. And as you guys can see, here we have a fair value gap. Price tapped into the fair value gap. As you can see, it entered the fair value gap right here, and it continued lower. Here we have a perfect example of a respected fair value gap. I'll show you another example. Here we have another fair value gap. As you can see, now this is a bit smaller, but it's always a wick. Also, if you can't see it, there is always a wick. The bottom wick that has a gap all the way to the first wick of the last candle. And we also have to focus on inverse fair value gaps. For example, here we have an inversion. Here we have price that creates a fair value gap right here. Price continues upwards, but then it drops. It drops and it inverses this fair value gap, creating another fair value gap. There was a change in trend, and price tapped into this other fair value gap and continued lower. This is a perfect example of an inverse fair value gap, which can be used in the 5-minute time frame, and it's key to spot major market movements. So what's a fair value gap? A fair value gap is an imbalance within price action. On the other side, what's an inverse fair value gap? An inverse fair value gap is an imbalance that has been inversed, or if you prefer, invalidated, and creating often, not always, a change in trend. This is exactly what an inverse fair value gap and what a fair value gap is. Now, coming back to what a trend is, we have to focus on changes in trend. Changes in trend are often called break of structure. A break of structure is when we have an upward trend, so a bullish trend, that will then be broken, creating a downward trend. So let's say we had higher highs and lower highs. We had an upward trend, a bullish trend, but then price drops below the last low. What happened? There was a break of structure. And what will the market most likely do? It will reverse and create a downward trend, also known as a bearish trend. So this is important to spot how the market will likely move for the next, 1 hour, 30 minutes, whatever. So a break of structure is often abbreviated to BOSS, is a change in trend. Okay? Easy, clear. So guys, these are the 3 main confluences I use to trade. Of course, there are many tools you can use to get better at trading. For example, there's Equilibrium, which is the Gann box right here. This is Equilibrium, so we have to mark out, for example, let's say we mark out this high and this low right here. Equilibrium is where price has to reach to then go lower or go higher. This is another important tool I use to take trades, but I will explain it in another video. So guys, these were the basics on trading, how you guys can get started and how you guys can slowly scale up and start learning how the markets move. Again, I have a free Discord down below where I go in depth on all these things where you guys can join. And if you guys are really interested in trading, you can join my private mentorship that you can find again down below, where I'll answer all of your questions during weekly live calls, and we'll get also daily live trading sessions. So if you found the video helpful, please leave a gentle thumbs up and please subscribe to the channel. See you in the next video.